Hello everyone, Alex Kim here. What we're observing in silver right now is not another volatile commodity experiencing a technical breakout. It's a market structure shift that's becoming visible in positioning behavior before the mainstream narrative catches up to what's already happening beneath price action. Silver just pushed above $115 per ounce and came within range of its record high at 117.74. And while that price movement captures attention, what matters more is understanding why institutional research divisions are now publishing price targets that would have seemed implausible 24 months ago, and what that repositioning reveals about underlying constraints in physical markets. Citigroup's global head of commodities research, Maximilian Leighton, raised their 3-month price target to $150. And that's not a speculative call designed to generate retail interest. It's a statement about how serious institutional capital is reassessing the fundamental drivers of monetary metals in an environment where geopolitical risk and questions about Federal Reserve independence are no longer theoretical concerns, but active market factors. This isn't speculation, this is positioning. When a major bank revises targets by 50% in a single move, they're acknowledging that the structural backdrop has changed in ways that justify meaningfully higher valuations, and that acknowledgement reflects institutional analysis of flows, supply constraints, and macro instability that retail commentary tends to miss. The immediate catalysts driving safe haven demand are specific rather than vague. Recent administration comments indicating comfort with dollar weakness to support export competitiveness send a clear signal that currency stability is being subordinated to other policy objectives, and that has direct implications for dollar-denominated assets. A weaker dollar reduces the cost of silver for international buyers, while simultaneously reinforcing the narrative that the United States is willing to accept currency debasement as policy, which is precisely the environment where hard assets that don't depend on governmental credibility become structurally more attractive. Add ongoing policy uncertainty in Washington, fluctuating tariff positions, challenges to central bank independence, and what some analysts are characterizing as a sell America sentiment among foreign investors, questioning whether U.S. assets remain the safe haven they historically represented, and you have capital flows redirecting toward assets that exist outside any single sovereign's balance sheet management. The Federal Reserve concluded a 2-day meeting with expectations that rates would hold steady at 3.5 to 3.75% following 3 consecutive cuts earlier in the year. And while the decision itself was largely anticipated, the forward guidance matters more because it determines whether the opportunity cost of holding non-yielding assets like silver continues to compress or whether higher rates reestablish a headwind. Higher rates typically pressure precious metals because they increase the opportunity cost of holding something that generates no income stream. When money market funds offer 4% with zero risk, the appeal of metal that sits idle diminishes. But when rates are falling, or when markets believe further cuts are probable, that calculation inverts and the inflation hedge argument gains traction. Right now, the market exists in a state where forward guidance remains ambiguous, and that ambiguity itself functions as a bullish driver for safe haven assets, because participants don't accumulate gold and silver when everything appears stable. They accumulate when uncertainty about policy, inflation, and systemic stability creates demand for assets that preserve value independent of policy decisions. Watch the flow, not the headlines. What's happening in China provides more insight into structural demand than any price chart. A pure-play silver fund had to halt trading not because of price collapse, but because demand intensity drove the fund's premium over its underlying assets to unsustainable levels. When a fund needs to halt trading due to excessive demand rather than panic selling, that signals supply is not keeping pace with flows, and the normal arbitrage mechanisms that should close premium gaps cannot function because physical availability is constrained. That's not orderly market behavior. That's a scramble for physical metal manifesting in dislocations that wouldn't occur in a well-supplied market. The detail that reveals investor rather than consumer psychology is that manufacturers are shifting production from jewelry to 1 kilogram silver bars. That shift tells you consumers aren't buying silver for aesthetic purposes. They're converting currency into hard assets in sizes that suggest storage and preservation thinking rather than decorative use. When investor behavior starts dictating manufacturing production decisions, you're seeing demand that's fundamentally different from typical commodity consumption. And that demand reflects capital preservation motives rather than industrial or consumer end use. Are you tracking how physical demand is manifesting in production shifts and premium dislocations that suggest supply constraints the paper market isn't yet fully pricing? If this type of structural market analysis is useful, consider subscribing so you can follow how these positioning dynamics develop as the cycle progresses. The deeper structural story extends beyond short-term catalysts into industrial demand that's been building systematically for years while remaining under-discussed in mainstream coverage. Silver is not purely a monetary metal. It's an essential industrial input for sectors that are expanding rather than contracting. Solar panel production requires silver for conductivity. Electric vehicle electronics and battery systems consume silver. The build-out of 5G infrastructure depends on silver, and data centers powering artificial intelligence and cloud computing all require silver. This isn't speculative future demand. This is current consumption that grows annually as these sectors scale. The green energy transition represents real capital deployment, real factory construction, and real silver consumption, regardless of political debates about timing or scope. The critical distinction that bulls emphasize and bears consistently underweight is that silver consumed in industrial applications doesn't return to the market. It's not stored in vaults waiting to be sold when prices rise. It's dispersed into products that will never be economically recycled. That means industrial demand isn't just a flow, it's a permanent drain on available supply. Every year, a meaningful portion of silver production disappears into solar panels, electronics, and infrastructure that won't return to circulation, which creates a structural tightness that compounds over time. When you overlay investment demand surging due to macroeconomic uncertainty onto industrial demand that's already consuming supply, you get a market that's fundamentally tight. And tight markets produce price spikes, not through manipulation, but through basic supply-demand mechanics, where more participants want metal than there is available supply at current prices. The public narrative lags the positioning. Mainstream financial media has limited attention span and strong bias towards stories that fit familiar narratives like growth stocks, bonds, or crypto. Silver doesn't fit neatly into those categories. It's a hybrid of money and commodity that confuses participants who prefer assets in defined boxes. That confusion creates opportunity because when an asset remains underfollowed and underappreciated by the mainstream, positioning can occur before the crowd arrives. Once silver becomes the dominant topic across financial talk shows and social media, the easy positioning has already happened. Right now, we're in the phase where participants paying attention recognize the setup while the broader market hasn't fully engaged. And that gap between narrative and positioning is where structural moves become visible before they're widely understood. The gold-to-silver ratio provides context on relative value between the two metals. With gold above 5,000 and silver around 115, the ratio has compressed significantly from periods when it traded at 80 to 1 or higher, meaning it previously took 80 ounces of silver to purchase 1 ounce of gold. The compression indicates silver has been catching up. And historically, when precious metals enter genuine bull markets, silver tends to outperform gold substantially. Gold leads initially as the safe haven asset that institutional capital feels comfortable buying first. Then, as the bull market matures and retail participation increases, silver catches up in surges that can feel disproportionate in intensity. Silver often consolidates for extended periods while gold grinds higher, then suddenly moves 20 or 30% in weeks. Those catch-up moves are what certain market participants constantly anticipate. And while not every setup delivers, the current combination of factors presents one of the more credible setups in recent memory. However, the bearish case deserves serious consideration because presenting only bullish arguments would be analytically incomplete. Higher real yields could return if inflation proves stickier than expected and the Federal Reserve is forced to reverse course. The dollar could strengthen if other economies weaken and capital flows back to U.S. assets despite uncertainty, and industrial demand could soften if the global economy enters recession. These aren't implausible scenarios, they're legitimate risks that could easily drive silver back to test lower levels. The psychological trap that destroys participants is confirmation bias, where you dismiss information contradicting your thesis while treating supportive data as validation of everything you already believed. When you become emotionally attached to a position, you ignore warning signs and write it down because admitting error feels too painful. The solution is process-driven decision-making rather than emotion-driven conviction. You need defined criteria for what would invalidate your thesis, specific price levels that would cause you to question your view, and honest answers to what you'd need to see to conclude you were wrong. If you cannot answer those questions clearly, you're not investing based on analysis. You're gambling on a narrative you want to believe. This is not a retail story. When volatility is elevated like it is currently, expect the market to test conviction in both directions. That means pullbacks, even sharp ones, are normal parts of the process. A $10 or $15 drop in silver would feel uncomfortable in the moment, but would be completely ordinary in the context of the move already realized. Markets transfer wealth from the impatient to the patient by making patience feel uncomfortable. If you're positioning in silver now, structure it so you can survive inevitable volatility. That means avoiding leverage unless you genuinely understand the risks, not concentrating all capital in one asset, and having a plan for what you do if price drops 20%, not just a plan for what you do if price reaches 150. The difference between professionals and amateurs isn't that professionals are always correct, it's that professionals are positioned to survive being wrong. They size positions so adverse outcomes don't destroy them. They define exit criteria before entering, and they treat every position as a hypothesis that could be disproved rather than a prediction that must materialize. Institutions don't chase price. They manage exposure. Different vehicles for silver exposure behave differently, and choosing the wrong mechanism can cost you even when directionally correct. Physical silver has friction. You pay premiums when buying and accept discounts when selling, and in fast markets those spreads widen dramatically. Physical works for long-term holding and wealth preservation, but performs poorly for short-term trading. Paper silver through ETFs or futures provides cleaner price exposure without premium and spread issues, but involves counterparty risk. You own a claim on silver rather than silver itself. For most participants, that distinction is academic, but in genuine crisis, the distinction could become material. Mining stocks are leveraged bets on metal price with added operational risk, management risk, and jurisdictional complexity. Some participants want the upside leverage, others avoid the complications. There's no universally correct answer, only the answer that fits your situation and risk tolerance. Consider diversifying across these vehicles rather than concentrating in one. Own some physical for long-term, some paper for liquidity, perhaps a small allocation to miners if you want leverage, so you're not betting everything on one mechanism working perfectly. Scaling into positions rather than committing entirely at one price reduces regret risk. When markets are volatile and outcomes uncertain, full commitment at a single price guarantees either immediate buyer's remorse if price drops or complete ammunition depletion if price rises. Instead, build positions in tranches, buy some at current levels, maintain cash for potential dips, add more if price pulls back while thesis remains intact. You're not trying to be perfect, you're trying to be positioned. Silver doesn't move first, stress does. The social media landscape contains extreme voices calling for $500 silver or crashes back to $20. And both extremes attract attention because extreme predictions generate engagement, but neither extreme is probable. Orienting strategy around extreme scenarios produces whipsawed results. The most likely path is continued volatility, higher highs accompanied by sharp corrections, frustrating both permabulls expecting straight advances and permabears calling tops. Participants who profit stay flexible, manage risk, and avoid emotional attachment to specific outcomes. The market doesn't care about your thesis, your research, or your confidence. It's simply aggregate behavior of millions of participants and will move regardless of what any individual thinks it should do. Your role isn't to predict, it's to prepare, to have a plan that functions across a range of outcomes rather than only the one you're hoping for. If silver pulls back hard to $100 or lower, does that represent panic selling opportunity or reason to add at better prices? Your answer reveals whether you're positioned correctly. If a pullback would cause genuine financial stress or emotional panic, you're overexposed and need to reduce position size. If a pullback would create excitement about adding at lower levels, you're thinking like a long-term investor rather than a short-term gambler. Both approaches can work. What doesn't work is being in the wrong approach for your personality and circumstances. We're experiencing a period of genuine monetary uncertainty where systems and institutions most people take for granted are showing stress fractures. That doesn't mean imminent collapse. It means the rules are changing, and participants who recognize that early will be better positioned than those pretending everything remains stable. Silver represents one method to express the view that hard assets matter, not the only method, not necessarily the best for everyone, but a tangible, historically proven store of value existing outside the banking system and beyond control of any government or committee. In an environment where institutional trust is eroding, that independence carries value. The Citigroup price target of 150 might be reached or it might not. The supply constraints and demand dynamics some participants anticipate might materialize or they might not. But the underlying fundamentals, the safe haven demand, industrial consumption, supply constraints, monetary uncertainty, those are structural realities whether or not any specific price target gets hit. What aspect of silver's current positioning do you think the market is still underestimating in terms of the intersection between physical supply constraints and monetary demand? This is an early structural phase in a repricing cycle driven by fundamentals that compound over time rather than resolve quickly. And understanding the distinction between momentum-driven moves and structural revaluation will matter as this develops further over the coming quarters and years.